Now we get to pivot to Europe. This segment's going to be pretty short. There's only 4 slides in it. Wasn't a ton of data that came out this past week, so we'll get a little bit of a reprieve. When we look at Germany, you can see CPI came in at 8.7% versus the estimate of 8.9%. Month over month staying elevated. Current account balance accelerated a bit, but some of the big pieces that we wanted to highlight is the wholesale price index, where you saw it accelerate again in January. And that's when you start looking at some of the data on electricity prices are starting to creep higher on the curve. You're starting to look at some of these concerns as, well, if things start to get normal, and if you think about, and by normal in terms of the economy turning back on, if you look at what Europe did, so prior to all of the issues with Russia, and even after they invaded Ukraine, they were still taking in piped gas. And they tried to take in as much as they could prior to sanctions and other types of stoppages based on, the shutdown of pipes, the blowing up of pipes. And then at the same time, it happened again on diesel. There was a huge run to absorb diesel, build up storage prior to sanctions. But the ability to build up that storage to the same degree with piped gas and purchases has diminished. And it's going to be difficult, again, as things start to normalize a bit, people start to try to do more of replacing that, which is why the re-rating of prices is going to be higher. And that's, I think, going to start to creep a bit more into the wholesale price index and the price index and CPI, which is why when we talk about inflation in Europe, we think it's going to actually stay higher than where the U.S., because the U.S. went up and obviously it's come back down a bit, as it will year over year. This has a bit more staying power because of some of those pressure points. Now, the Eurozone aggregate, as we showed previously, industrial production was expected to come in at negative 0.8, came in at negative 1.1%. Trade balances worsened a bit. And again, as you're seeing, it's just there's some of that negativity that continues to come through and is showing towards additional slowdowns. So now when you look at the European investor, they see more central bank tightening in response to resilient inflation. And as we keep showing the acceleration side, it's just rates have to go up. And I think when you look at, like, when we talked about the IMF estimates for GDP, it's a bit lofty because inflation is not going away. There's a lot of those GDP numbers are of the expectation that inflation declines, and as inflation cools, you won't need as many rate hikes. You could actually see some countries start to cut, and that will help drive some of that growth. What we're saying is that inflation is going to be very sticky, and it's going to be here and really relaying into that stagflation that's going to be problematic going forward. And so that's why we agree with investors on this point. And then threats to European earnings. It's going to continue. Global manufacturing PMI, new orders versus inventories, all moving in the wrong direction. And Europe is a big exporter. So that's going to pull down economic activity while inflation, again, staying elevated. So that's why credit standards are already tightening, and they're going to continue to tighten given what banks are doing, given what the ECB is doing, what other Fed and central banks are doing in terms of driving some of this higher. So German wholesale prices, just kind of putting it into context. And then the consensus for 2023 CPI in the Eurozone, it's staying elevated. And that's what we've been talking about. And you'll get some disinflation in the near term because we're coming to a point where you had a big spike in electricity prices and some of the others. But again, the re-rating higher is going to make this sticky and going to make this a bit more problematic when we look at some of those overhangs, which is why we think the ECB is going to have to stay more aggressive. The consumer is already weakening, real wages have fallen, and we actually think Europe is going to have a much harder time than what I think the market is expecting and what investors are expecting on the global growth front, and obviously in the European growth front. So that's what we have for you on the European side. As obviously more data comes out that is, we think is relevant or going to be driving, we're going to bring it to you as best we can. And now in the next segment, we're going to go deeper into China, Asia, and this next segment we're going to talk a bit more obviously about China, as we always do, but also more about India, because some of the data that came out was a bit surprising on some of the inflationary fronts.